The financial war zone has officially opened, and if you don't feel it yet, it's because you're looking at the wrong screen. This isn't just another headline cycle, another hot CPI, another Fed speaker, another tariff rumor. This is what it looks like when policy, debt, and supply chains all start pulling on the same rope at the same time, and the market stops rewarding normal. It starts punishing exposure, punishing leverage, punishing complacency. In a war zone, the question is never, what's the best return? The question is, where's the exit, and does the exit still work when everybody runs for it at once? And right now, the exits are getting narrower. Bonds don't feel like the clean hedge they used to be. The dollar doesn't feel like the automatic shelter it used to be. And risk assets can turn into trap doors when volatility wakes up. So capital does what capital always does when confidence cracks. It moves toward things that don't need permission. That's why gold is not acting like a commodity anymore. It's acting like collateral, like insurance, like the asset you reach for when you don't like the math. And demand has been proving that, not in theory, but in size. Total gold demand in 2025 topped 5,000 tons, with investment activity and central bank buying still historically elevated. Source. And silver is the high beta pressure valve. It's monetary when fear hits, and it's industrial when the real economy needs it, and those two forces can collide. The Silver Institute expects the market to remain in deficit again, with industrial demand staying a key driver. Source. Here's how we're going to frame this today, because if you try to trade a war zone with yesterday's playbook, you'll get chopped up. We're going to watch three things in real time: the bond market stress level, the dollar's ability to behave like a shelter, and whether risk assets can actually catch a bid without volatility immediately punishing them. When those three start fighting each other, that's when you get the kind of environment where diversification suddenly means something very different. And that's when the metals stop being a sideshow and start being a primary signal. Source. The yield curve is the market's lie detector. It's not a crystal ball, but it tells you what the market is paying you to believe about the future, because it's literally the price of time across Treasury maturities. When the curve starts shifting in a way that says inflation risk is sticky or financing conditions are tightening in the wrong places, it changes the entire chessboard for equities, for credit, and for the so-called safe assets. And if you're waiting for the headlines to confirm it, you're already late, because the curve usually speaks first. Source. Now layer on top of that the policy direction. Washington is not talking about minerals like it's 2012 anymore. The language is national security, economic security, domestic production, processing, refining, and reducing reliance on foreign supply chains. That matters because when governments start treating inputs as strategic, they don't aim for cheap, they aim for available. And those are two very different price regimes. Source. So the promise of this video is simple. By the end of it, you're going to know what to watch today, what would confirm that the war zone is expanding, and why gold behaves like the first exit while silver can behave like the fast exit, especially when the underlying supply-demand math stays tight. Good morning, everyone. Welcome back. This is your morning markets and metals rundown, and the goal here is simple. We're going to cut through the noise, line up the few variables that actually move the tape, and get you positioned mentally for what kind of day this is going to be. Because when the financial war zone is open, you don't get rewarded for having opinions. You get rewarded for reading reactions, understanding pressure points, and knowing what matters before the crowd figures it out. So here's how we do it. First, we take the snapshot. Rates, dollar, equities, volatility, metals, energy, and one risk barometer so you can feel the temperature of the room. Then we take the headline and we translate it into second-order effects. Not what happened, but what does it change? What does it change for inflation expectations? What does it change for the Treasury curve? What does it change for funding conditions? And what does it change for capital flows? Because that's the chain that ends up telling you whether gold is acting like insurance and whether silver is starting to behave like a scarcity asset with a fuse attached. And then we go to the charts. Not because charts are magic, but because charts tell you where people are forced to make decisions. That's where stop levels live, that's where breakouts get proven or rejected, and that's where you find out if the bid is real or if it's just a headline pop that's going to fade by lunch. So let's get right into it. Let's start with the markets, get the tape read, and then we'll come right back to the main story, because if there really are only exits left in gold and silver, you're going to see it in the way everything else is behaving. Right. Overnight, the bond market is trying to calm down, and then it's getting pulled right back into the fight. You've got the long end wobbling, you've got the front end still sensitive to anything Fed adjacent, and you can feel that the curve is not giving you that clean, comforting message. It's basically saying, we're still debating inflation, we're still debating growth, and we're still debating whether this financing path is sustainable. The dollar is trying to firm up, but it's not acting like an unquestioned safe haven. It's more like a trade right now than a sanctuary, and that matters because when the dollar can't dominate the room, the metals usually don't need much of an invitation. Equities are mixed to heavy, and it's one of those tapes where the index level matters less than the internals. You can have the headline look fine while volatility quietly prices in trouble. And that's what the VIX tends to do in this kind of environment. It creeps first, it doesn't announce itself. Now to the metals. Gold is bid, and it's staying bid, which is the key. Silver is acting like silver, meaning it's moving with more torque, more emotion, more speed. Copper is soft, which is a tell if you're looking for growth confidence, and the complex is basically split between safety and cyclicals. Platinum and palladium are trying to find footing, but the story this morning is still the monetary side of the board. Energy is holding up better than it should on lukewarm news, which is constructive, and natural gas is doing what natural gas does. It keeps you humble. Grains are a little heavy, and Bitcoin is still in that zone where it can base and turn, or it can roll over and remind everyone it's not a bond. That's the snapshot. Now let's get into why the war zone framing actually fits today. Right. The reason I'm calling it a financial war zone is because you've got multiple policy fronts opening at the same time, and they don't resolve neatly. You've got governments trying to control outcomes they don't fully control. You've got markets trying to price inflation and growth at once, and you've got investors realizing that some of the old hedges don't hedge the way they used to when the system gets stressed. That's when the tape stops being a spreadsheet and starts being a battlefield. And the bond market is where you see it first. The yield curve is literally the price of borrowing across different maturities, and it moves on expectations for Fed policy, inflation, and the term premium. When that curve shifts, it's the market telling you what it thinks the next phase looks like, whether that's tighter funding, stickier inflation, or more uncertainty about the path. It's not about memorizing definitions, it's about recognizing that a curve that can't settle down is a market that can't relax. Source. Now add the strategic layer. Washington is not whispering anymore about minerals and supply chains. The language is national security, domestic production, processing, refining, and reducing dependence on foreign sources. That matters because when policymakers start treating inputs as strategic, they push the system toward a secure supply, and secure supply is rarely synonymous with cheap pricing. Source. So in that environment, gold and silver stop being optional. Gold becomes the default collateral trade, the insurance trade, the I don't like the math trade, and that demand has been persistent at scale. Source silver then acts like the levered version of that thesis because it's monetary when fear hits and industrial when supply chains tighten and deficits keep that underlying tension alive. This is the part that most people still aren't pricing correctly because they're treating silver like it's just another line on a commodity screen. Washington is treating minerals like infrastructure and defense. The language coming out of policy is not nice to have, it's must have, and it's framed as national and economic security. When that mindset takes over, the objective stops being the lowest possible price and starts being secure, predictable supply, and those two worlds do not trade the same. Source. Read what they're actually saying. They're talking about domestic mineral production to the maximum possible extent, and they define production as the whole chain, mining, processing, refining, smelting, and even the derivative products that depend on those inputs. That is the tell. The real choke point is not just pulling it out of the ground, it's what happens after, the conversion into usable metal, powders, alloys, and the industrial stack that sits on top of it. If you're trying to rebuild that at home, you don't do it with collapsing prices. You do it with incentives, approvals, capital, and time, and policy can accelerate all four. Source. They're also moving on speed. Priority projects, expedited permits, land use priorities, and even Defense Production Act authority being pointed at strategic resources. That is not background noise. That's the government effectively telling you, we are willing to treat inputs like a strategic asset class. And when that happens, foreign supply chains don't just compete on efficiency, they compete against policy. Source. So when people ask, why would silver stop being cheap? This is a big piece of the answer. Strategic framing puts a floor under availability concerns, and when availability becomes the priority, the market starts paying up for certainty. Gold is the cleanest tell in this whole war zone because it's not rallying like a trade that needs perfect conditions. It's rallying like something that's being re-rated as a core asset again. When you see gold printing new highs and then refusing to give it back on the first dip, that's not just momentum. That's a bid that has a reason. And the reason is that people are losing faith in the idea that paper promises are enough when the macro gets noisy. Source. Look at the scale. Total gold demand in 2025, including OTC, exceeded 5,000 tons for the first time. And the price set 53 new all-time highs during the year. That's not a one-week headline reaction. That's a year-long message from global capital that says diversification is no longer a buzzword. It's a requirement. And it wasn't just one pocket of demand doing the work. It was multiple engines pushing together. Source. You had investment activity driving it, with global gold ETF holdings up 801 tons, and bar and coin buying accelerating to a 12-year high. Those are two very different buyer types showing up for the same reason, and that matters. It tells you the bid isn't fragile. It tells you this isn't just a fast money move. It's portfolio behavior changing, and once that happens, gold starts trading less like a commodity and more like an alternative reserve. Source. And then you've got the official side. Central banks bought 863 tons in 2025, still historically elevated and widespread, even if it slowed from the most aggressive pace. That is the quiet part of the story, because central banks don't chase, they reposition. So when you combine official accumulation with retail and institutional investment demand, that's when gold becomes the first exit, not the last. Source. Silver is where this Warzone gets loud, because silver doesn't get to be only one thing. It's not just a monetary metal, and it's not just an industrial input. It's both. And that means when fear shows up at the same time, supply chains tighten, silver doesn't glide, it snaps. That's why silver can feel quiet for weeks, and then, all of a sudden, it moves like it's trying to reprice an entire regime in a handful of sessions. In a calm market, that volatility is a nuisance. In a stressed market, that volatility is a signal. And the fundamentals underneath it are not benign. The Silver Institute is projecting another deficit year in 2025, the fifth consecutive year, even though supply is expected to grow and recycling is expected to pick up. Total demand is expected to be roughly stable around 1.20 billion ounces. But industrial fabrication is forecast to grow again and push above 700 million ounces for the first time, driven by structural applications that don't disappear just because the tape is ugly. Source. They're pointing directly at the engines. Photovoltaics still pushing installations, automotive electrification and vehicle sophistication continuing, and the AI build-out supporting consumer electronics demand. In other words, even when one lane slows, another lane takes the baton. And that's why silver keeps finding itself in this tension where investment demand can surge on macro fear, while industrial demand remains real-world sticky. Source. So when people say, why does silver overreact? It's because silver is the pressure valve. Gold is the exit you take when you want calm. Silver is the exit you take when the door is narrowing and you need speed. And in a deficit backdrop, that speed can turn into torque very quickly. Source. Now, let's stack the authority the right way. Because in this environment, you don't want to be right, you want to be on the same side as the flows. You've got three different buyer classes behaving like they're responding to three different threats, and that's exactly what a war zone looks like. The official side is thinking reserves and credibility. The institutional side is thinking collateral, balance sheet, and liquidity. The retail side is thinking purchasing power and upside, and those three motives can all point to the same place at the same time, which is why the moves can get persistent. Central banks were still net buyers at historically elevated levels in 2025, with reported purchases of 863 tons, and that's not momentum chasing, that's repositioning. Source. Then look at how the investment complex behaved. Global gold ETF holdings grew by 801 tons in 2025, bar and coin buying accelerated, and the demand story didn't need perfect macro conditions to show up. That's why gold is acting less like a commodity chart and more like a core balance sheet asset again, because the demand is coming from different angles, not one fragile pocket. Source silver sits right on top of that, but with more torque, because it's not just a fear trade, it's an input trade. The Silver Institute is still modeling a deficit market in 2025, and industrial fabrication is expected to clear 700 million ounces for the first time, which means the supply-demand backdrop stays tight even if the tape gets choppy. When you combine that with any kind of risk-off bid, silver doesn't drift, it reprices. Source. And the last piece is policy. When the government starts talking about mineral production as national security and defines it as mining plus processing plus refining, you're not in a cheap inputs world anymore, you're in a secure inputs world. That's how price floors get built, not by speeches, but by incentives and urgency. Source. This week is one of those weeks where the calendar matters because the market is already on edge, and in a war zone, the smallest spark can move the whole front line. You want to be watching inflation prints like PPI and CPI, not because the number itself is magic, but because of how rates react and how the curve reacts. The yield curve is the market's pricing of time and risk across maturities, and when that curve starts shifting aggressively, it changes the rules for equities, credit, the dollar, and the metals in one shot. If inflation comes in sticky and the long end sells off anyway, that's a very different world than a soft print with a bull flattening move that calms funding. Reaction first, interpretation second, source. Then you've got the Fed communication minefield. Minutes, speeches, any hint about the pace of easing or the tolerance for inflation that can flip the dollar and flip the metals intraday. Layer on treasury auctions and supply, because weak demand there doesn't just move yields. It feeds the narrative that the bond market is not the unquestioned escape hatch anymore, and that's when gold acts like collateral instead of a trade. And finally, you have policy and geopolitics, which are not background anymore. Trade headlines, tariff mechanics, refund ambiguity, and the broader push toward domestic mineral production and secured supply chains all keep the uncertainty premium alive. When governments are explicitly framing mineral production as national and economic security, that's not a one-day story, that's a multi-quarter pressure that can change how markets value availability. So your job isn't to predict the headline. Your job is to know what kind of tape you're in when the headline hits and whether gold and silver are being bid before the story is even fully written. Source.